You've been told that debt is evil, that debt is dangerous, and avoid it at all costs. But what if that belief is exactly what's holding you back from building real wealth? Is it actually possible to build wealth like the wealthy using debt? Can it be used wisely? Where's the line? How do you use it wisely versus not? That's what I'm going to cover in this episode right now. Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. The show is for you if you actually want to become work optional by having enough passive income coming in to be able to work because you want to, not because you have to. And this is also for you if you actually want to create a ripple effect through the lives of others, because you're not just here to get rich. You're here to live a rich life by increasing your stewardship so that you have more than enough money to not just take care of your family's needs, but create a ripple effect through the lives of those around you. And that is exactly what I'm here to do with this show right now for you in your life today. Thank you for tuning in. You've been binging, you've been sharing this episode. You know you have. Thank you so much for doing all of that, because we could not do this all without you. And it's all because of you we're able to make this happen. So thank you so much for being a part of this movement and helping at least 1,000 families become financially independent by the year 2030. That is because of you. So thank you for tuning in and being part of it. Hey, if you ever have questions for us, you can actually see there at moneyripples.com what it takes for you to become work optional, creating an actual blueprint to do that. If you're curious about that, or even about how to create a freedom fund using max ROI infinite banking, go ahead and visit us at moneyripples.com. All right, let's talk about debt. Let's talk about debt, baby. Let's talk about you and me and whatever. Okay, so let's talk about debt, right? Sorry, I just had to do a little salt and pepper there for you guys. For those of you old enough to remember who salt and pepper actually is. So debt, what are we going to do about debt here? Isn't it evil? Isn't it horrible? I will tell you from my own experience, I was taught that debt was bad. My dad was the perfect example of the guy that says, I'm going to save everything. I'm not going to spend money, and I'm going to make sure I'm debt free. He paid off all of his debt, including his house, in 18 years. He's the kind of guy that paid cash for his cars. And I remember the first time I saw him bring in $10,000 of bills, cash, to bring to the dealership to buy his car back in like 1990 or whatever it was. And I remember thinking like, wow, that's a ton of money. And so he would pay things in cash. He would try to be debt free because that's what he was raised in, that Depression era mentality. Now, what's so fascinating is that, of course, I get to be an adult. And I remember the first time, this is when I was kind of at the end of college years, I was working full time. And all of a sudden I realized, because, I was going through a divorce and finances were a little bit jumbled up, of course, and things like that. And all of a sudden I realized that I used my overdraft account at my bank. It was a few $100s, and I freaked out. I didn't know what to do because I think I had a credit card, but I'd never used it before. I mean, I remember my in-laws told me, get a credit card. You need to get it to build your credit. I'm like, okay, whatever, I'll do it. But I never intended to use any kind of debt at all. If I didn't have cash, I didn't pay for it. It was very much like that envelope method. And what happens, I use my overdraft for the first time. I'm thinking like, oh my goodness, how am I going to do this? How is that possible? Like, am I going to get in trouble? And of course the bank's like, no, you just need to make at least your minimum monthly payment or pay it off at some point and you're good. And so understand that my perspective was that debt was bad. And then I even went to a church where they would even say avoid debt like the plague, right? And that's the worst thing ever, and never have debt, or avoid at all costs. And if you get debt, pay it off as fast as possible. Very Dave Ramsey-esque in its teachings. And so I was raised in that kind of thing. So just understand that I'm not somebody who loves to take a lot of risks. In fact, if you've watched or listened to enough of these episodes, you already know, I think most of Americans are way riskier. The Americans that save in 401ks are way more risky than I am, because they're putting money in the stock market. And I think that's a gamble. That's a crapshoot. I wouldn't do that. So I'm very risk averse. And so when we talk about debt here, the question is there such thing as good debt or bad debt? We hear Robert Kiyosaki talking about that all the time in Rich Dad Poor Dad, but is that really the case? Or is that just a marketing ploy that he's teaching you something that's really dangerous? And I'll tell you, it can be either. Because I'll tell you, debt is neither good nor evil. Debt, for one, is the definition of debt is actually different than what people call as debt anyways. It's not good or bad. It's just what is. How you use it as a steward, however wise of a steward you are, that could be good or bad. I'll say this. We've talked about scarcity already. We've talked about spender and saver mentality, and those are both in scarcity. They both lead to, I wouldn't say financial ruin, but you never will find financial freedom there. You have to become a wise steward. Stewards actually love debt. Wealthy actually don't mind debt very much at all. If that were the case, why do banks have so much of it? Look it up. If you're in, by the way, if you're investing in the stock market and you've got banks in your portfolio, look to see how much debt to income, or if you're one of those people that have stocks in your portfolio, including bank stocks or other financial institutions, take a look at their debt to equity ratios. If it's more than 1.0, that means they have more debt than they have assets, which in most banks' cases is true. They do that. I even recall, now this hasn't been the case, but even when Steve Jobs was in control of Apple right in his last final years there, Apple, and even after Steve Jobs had just passed away, Apple actually had billions of dollars of debt. What's crazy though is they had billions more of cash sitting on the side. So they had more than enough cash to pay it off and still have a surplus, but they still didn't pay off their debt. Why? Why are these companies, why are some of the wealthy people using debt all the time? Why is Elon Musk using debt to actually pay his income? Did you know that Elon doesn't pull off an income? He uses debt using his stock as collateral so that because let's be honest, the interest he's going to pay on that is going to be way less than the taxes that the government will charge him. So he uses debt to pay his own income. I mean, that's what a lot of wealthy people do, even in their own cases of trying to pay themselves. And so, heck, even Jim Harbaugh, guys, if you've heard us talk about infinite banking, using that freedom fund, right? That max ROI infinite banking method. Jim Harbaugh, who's now the coach of the San Diego Chargers football team, for those of you who aren't football fans, he was the coach of Michigan, right? He actually was given a $2 million a year bonus that was paying as a loan to his life insurance policy. Why would he do that? Why would so many of these people be willing to use debt? Is it possible that maybe, just maybe, they know something that the average American does not know? And that's the case. Wise stewards love using debt, but spenders, they should never have debt. If you're somebody who's going to blow your money, debt is a horrible, horrible idea. You should not have debt. If you're a saver, you don't want debt either, because why? You've been brainwashed for so long that debt is evil that you never want to have it. The real question is, where did that teaching even come from? Now, yes, the Great Depression was one of those times. The Great Depression, we watched what happened when people were not able to pay on their debt. Now, understand that there was different rules that we were playing by. During the Great Depression, it was possible that the banks, who of course were desperate for cash, that banks could actually call mortgage notes due. So if you were someone who had a mortgage on your house and you were making on-time payments, at that time, the bank could say at any moment, hey, listen, we need the money. I'm calling that full amount due now. So let's just imagine, like, we're doing this in today's dollar amounts, right? Let's just say that you had a $500,000 mortgage on your house and you've been paying faithfully for several years. And you're like, you know what? I'm doing good. I'm doing great. My mortgage interest is not that bad. It's actually pretty good. I've locked it in. It was at a low rate of like 3%. And then all of a sudden, recession hits and the banks say, you know what? We need that money back. You need to pay us that $500,000 right now, or we're taking your house away. Imagine how that would feel. That's exactly what many people felt during the Great Depression. When banks were calling those notes due, because again, everybody's running on the bank to pull the cash out, the banks didn't have it. In fact, the banks had a lot more debt. They still to this day have more debt on their books than they have assets. They can literally lend you more money. It's called fractional reserve banking. They can actually lend you up to 10 times more money than what they have in their available cash. So if they have, say, 1 billion sitting in cash in their accounts, they can loan out $10 billion in loans. So yes, if people stop paying on their loans, if people start pulling the cash out of their banks, banks might be in a little bit of a pickle, and they might say, what am I going to do? Now, of course, this is why the government went in the last global financial crisis. Some of them bailed out some of these big banks. Now, granted, the big banks actually had permission. The 5 big banks had permission to loan out 40 times what they had in cash. That was part of the problem. They were overly aggressive on getting into excessive debt themselves. That's why we had that issue. But the rule is different today. If you make on-time payments on your mortgage, assuming this is your own home, right? It can be different sometimes depending on the kind of investment property mortgage you get, but you can always request to make sure that they can't do that. However, if you have your own home, they cannot call the note due. If you're making on-time payments, you're fine. We're in a different period, different rules. Now, could that change in the future? Maybe. But right now, that's not the case. You can have debt and be fine as long as you make at least the monthly payments. That wasn't the case for our grandparents and our great grandparents during the Great Depression. And that is why debt, for a big reason, was taught that you got to pay it off as quickly as possible. Don't carry debt, maybe even pay cash. Dave Ramsey, his perspective, remember, he was taking very high risks in his real estate game. It wasn't because he was doing real estate, it's because of the method he was using. The strategies he was using for real estate were very here today, gone tomorrow. When the banks all of a sudden realized this 20-something-year-old kid was making millions of dollars and doing a lot of crazy high-risk strategies with real estate, they put the kibosh on him, called the notes due, because in his case, they could do that, and he didn't have the cash to pay. And that's where he came out saying, I'm never going to have debt again, right? Think about it. It was all inspired by trauma, scarcity, not because of wisdom. Now, there is wisdom, of course, that can come from that, knowing there's a possibility, right? But don't play by rules just because people had a bad traumatic experience, especially when it's a one-off experience, not the common experience today. That's what you want to watch out for. This is why, with my trauma, right, when I had my situation with the last recession, I learned don't put a lot of equity in my house. Don't pay off my debt faster, which is what I was doing. Because when I paid extra money on my debt, what happened is that, of course, as the markets got tighter, I couldn't get access to that equity. I wasn't liquid with cash. I didn't have enough money to keep making payments and keep helping my family out, especially when the business was suffering at that time too. So the business was suffering. As a result, my personal finances were suffering. I didn't have the money to pay on that mortgage. And of course, what happens next is the values are dropping. All that equity disappears. The banks wouldn't let me short sell the property. And mainly it was Lehman Brothers, and they got sued for it, by the way. But if they would have let me do it, I would have got out from the property and been fine. I wouldn't have owed any money. I would have been out. I wouldn't have been happy, but at least I would have got rid of the property and forgiven my debt and moved on. Instead, I had to go worse and went into foreclosure, which even has a harder aspect on your credit report, 7 years, right, to be exact. And that affected my credit, like destroyed my credit as a result because they wouldn't even accept it. And so I learned, don't stuff equity in there, stay liquid, right? I learned that from my trauma. Now, I think that works in any kind of market. Now, can you go excessive? What if I went to scarcity and I always kept liquid money and I just never put it to use, always kept in a savings account, which isn't always safe anyways. But I did that. If I only did that, then I'm making kind of unwise decision as a steward because I'm not growing my money the way it should be. So it's finding that right balance. So understand that debt wasn't bad. Also understand too, the mortgage companies love teaching you to pay off your debt faster because of what I just explained to you just a few minutes ago. Remember I explained that for every dollar you give them, whether it's extra money you pay in principal on the loan or a dollar you put into a savings account, they have the ability to loan up to $10 of that money. So if you're a bank, and think of this from a perspective that bankers are investors, right? They like to be wise stewards of their money. They are investors first and foremost. They like to make money on their money. They'll make interest off of you, of course, if you're paying back on a loan. But why would they want you to pay back your loan faster? Think about this. Why would a bank do that? If you've been following this podcast, you're probably looking for great ways to create passive income right now, right? Well, we got you covered here with Central Lending. Central Lending specializes in alternative investments that actually are designed to create steady returns and long-term financial security for you and your family. Now, they prioritize transparency. They love, building those strong relationships, giving you that confidence and peace of mind, knowing that you have your money working harder for you, so you don't have to work so hard for that money. You want to learn more how to do that? Go to centrallending.com and check out what they've got today to create your passive income and wealth creation right now. Why would a bank say, you know what? Why don't you do that 15-year mortgage instead of that 30-year mortgage? In fact, I'll give you a better interest rate. Many people, and this is what I taught, and this is what's completely a false lie. Is a false lie? Is that redundant? Anyways, it's a lie. Is that I would teach people, if you want to stick it back to the bank, pay off the loan as fast as possible. In fact, what you should do is get a 15-year mortgage. You'll hear Dave Ramsey teach this a lot too. 10 or 15-year mortgage, not the 30-year. Well, if banks really loved keeping you in debt, wouldn't they love to incentivize you to get the 30-year mortgage? What's the best way for a bank to incentivize you to get a different type of mortgage or get a specific mortgage? They won't charge you more interest. Charging you more interest does not incentivize you to get it, right? No, they charge you less interest. They say, hey, you should do this loan. Your interest rate's less. This is how they incentivize you to do the loans that they want you to do. Well, where do you get the less interest rate? Is it a longer term 30-year loan? Or is it the 10 or 15-year loan? Which one's less? 10 or 15 years every time. They love the shorter term loan. Well, that doesn't seem to make sense because wouldn't they want to keep you in debt longer? No, not if you understand how they use money. Like any good investor, they want their money to come back faster. They don't just want to earn interest on their money. They want to get some of that money back too so they can reinvest it and make more off of it. They're always cycling money. They're always using money. Again, stewards of money, not hoarders or savers that just set it and forget it. That's not how banks work. Banks know how to make real money. And this is what the wealthy do too, that they know they're always keeping money in motion. They're always making it work for them. So no, they want you to pay them back faster because for two reasons. One, they get that money back. And for every dollar you give them, they can loan out 10 more dollars. Do the math on this. You create a bigger acceleration of wealth by having more leverage when you get more of that money back. Think of it from your perspective. If you're just going to buy an investment property and you know you can put 20% down on that property, you would love it if rent came in faster, those payments came in more, which built up the cash so you can go put that next 20% down on the next property because you know that those properties can appreciate. And of course, you have renters, they'll pay down your mortgages for you anyways. And you create more leverage, more use than just buying out and cash outright. So yes, that velocity of money is always moving. They love velocity of money. And you should too, right? If you know how to be a wise steward. Again, if you're a spender, you'll just blow it. You won't do anything good with it anyways. If you're a saver, you'll just freak out and you'll hate the debt, right? You've got to become a wise steward of your money to do that. And so again, debt, if you're using it wisely, can be an amazing tool, amazing way to create wealth. In fact, it's one of the better ways to do it. I have a friend, Sam Primm. You guys ever look him up on social media and stuff? He's got a lot of Instagram and TikTok followers, and he gets blasted. He even got blasted by Dave Ramsey. I even did a react video to that because of Dave Ramsey blasting my friend Sam. Sam talks about all the time. He has $50 million real estate, but he has $30 million of debt. So he'll lead saying, I've got $30 million of debt and I'm glad for it. And most people would cripple thinking about $30 million of debt, but he'll say, no, but that $30 million of debt allowed me to buy $50 million of real estate. And so here's the deal. And this comes back to what debt really is. You look at debt to equity ratios. Debt and equity are opposites, right? So understand this. So Sam, give his example, right? He owns $50 million of properties with $30 million of bank loans against it. How much debt would he have if he sold off those properties? Assuming they sold off for $50 million. How much debt would he have after he did that? Goose egg, right? Zero debt. He would in fact have $20 million of cash that he would have on hand. Now, he also makes several $100,000 a month with those properties too. So he's not selling them off, right? But he can sell off specific ones, whatever he wants. But that's the point, is that he is technically debt free. Now he has $30 million of liabilities and loans, but he is not in debt. He is debt free because he has enough assets to sell off, pay off all of his debt and then some, and has to have a surplus. It's just like when you buy a car. You know, if you drive a car off the lot, you're upside down on it. Well, if you were to try to sell off the car, whatever's left over, that's the debt, right? That negative equity is debt. That's why when you look at companies, they have the debt to equity ratios. The question is, how much debt versus equity? Debt is only negative equity. When you're upside down, that's when you have debt. When you can sell off all your assets and you still have debt left over, that is your debt, not the loans. That's a liability. Understand that assets and liabilities is different, right? That definition is different. A liability is something that you owe on, and I'm overly simplifying this, where assets are things that you own. Own versus owe. Those are the loans. The loans are liabilities, but it's not debt. Debt, and this is where it does get scary, the last recession, when a lot of people were having problems because they didn't have equity in their properties. They were literally getting properties with 0% down or almost nothing down for those properties. And then, of course, when the values tanked, they had nothing. Even in the multifamily space, we talk about apartment buildings all the time, especially in the last 3 years. They've had a horrible time. Not because they didn't have equity. Many of them had equity, 20 to 30% in many cases. But when the interest rates skyrocketed too high, too fast, all of a sudden, because the valuation of apartment buildings are based on profits, based on current interest rate environments, because it went up so fast before rents could catch up, what happens, we lost 20 to 30% of that value. So we had lots of these guys that were great operators that had made lots of money. And what happened is that they now have these properties with no equity in them. There was enough cash flow coming in because now all of a sudden they raised interest rates because they were short-term loans. They didn't have long-term financing. They had short-term financing. They couldn't get a lower interest rate. It cost them more money. They were going in the hole and they lost, and lots of people lost a lot of money in the apartment buildings. And that's even true with self-storage and other similar types of assets. There's where debt, quote unquote, debt becomes a problem. In those cases, they actually got to a point where they lost all their equity and now they were moving into a position of debt. The key is this, is that having loans is not a bad thing if it's backed up by real assets. So getting high interest credit cards, is that necessarily wise? Not necessarily, right? That could be a bad thing. Or could it? Because credit cards, even those, aren't necessarily good or bad debt. It's just loans, right? I'll call it a liability. So I'm calling debt as the general public calls it, right? But it's not good or bad. It's neutral. It depends how you use it. I've taken out loans. I've used credit cards. Heck, I use a credit card to go and do certain types of things to pay for like my podcast, for example, and pay for certain things, especially if I had to invest a lot of money up front. I was like, you know what? I'm going to invest money up front. Plus I'll get some bonus points and miles and things like that for my Delta Sky Miles card, right? I'll use that to get the points. But there's times I didn't have the money to pay it off all at once, but I might pay it off over a couple months and paid off in cash. Fine. There's been times I've stretched out debt. I remember I got an SBA loan for my business. And why? Because I got a $25,000 line of credit, but the payment was only $150 a month. Think about this. If I can service that debt payment, right? That loan payment, notice I'm interchanging these now. If I can service that loan payment by making at least $150 a month with that money invested in my business, that could be a great investment in my business. Now, on the other hand, if I use $25,000 and I piss it away, then that's not a good investment, right? That could be bad. But for many business owners, they get this. This is why guys like Apple, like companies like Apple would have trillions of dollars just sitting around. Sorry, not trillions, billions of dollars sitting around. I'm thinking government numbers now. Government debt, that's another story. That's debt. But when it comes to businesses like Apple, they had billions of dollars in debt, but they also had billions of dollars in cash. But they were prioritizing much more keeping that cash liquid now. A lot of times they'll do that, especially if there's big projects coming up, or maybe they're thinking there's more research and development they're going to do to develop new products or whatever it might be. They're keeping cash on the sidelines while also holding a loan or loans in their case. That could be okay. So just remember that debt or loans are not good or bad. It depends on how you use them. Heck, when I get a mortgage on a property, I don't mind it as long as the rent payments I'm earning pays more than that. Now, right now, especially this is why I tell people like buying on the western half of the United States, buying a rental doesn't make sense because you have to make it more than enough money. And what usually happens is I see a lot of people, and this isn't always bad, but some people think, well, the only way I can make enough money to consider having a rental in the western half of the US, because it's in my backyard, is to do a short-term rental. But then they don't know what they're doing, or the short-term rental market is not as good or as strong as they thought. And what happens is that now their mortgage payment is still higher than the income coming in. That's not a wise move. So when you're using loans, right, even if you use a home equity line of credit, you want to make sure that whatever you use it for, it's going to have more than enough income coming in to pay for that payment and ideally have a surplus. That is when I think it's wise to use that debt, quote unquote, or those loans, right? So just remember this. Is debt good or bad, right? Are loans good or bad? It depends. Are you a wise steward or are you not? Wise stewards will always find a way to use money in a very good, efficient way. Unwise stewards, specifically spenders, or even though they're hyper-focused, like hoarding savers, they might make emotional decisions that actually jeopardize their own financial health. That's what happened. That's what happened with Dave Ramsey. That's what happened, when we're playing by different rules before, right? Again, it's always based on the current money rules that we're playing right now. Right now, debt can be a very, very good thing in as much as you use it wisely. So that's how the wealthy use it. The wealthy use it as an amplifier, just like my friend Sam, just like I did as well. I did the same thing to help build up my assets faster because I was able to get that benefit. And by the way, when I buy a property with 20% down and it appreciates, let's say appreciates 10%, I don't make 10%. With a 20% down payment, I make a 50% return because I only put a fifth of the money down, which gives me a 5 times multiplier on any equity gains. This is why there's so many accidental millionaires in the real estate game. Imagine with your own home. You put that 3.5% down payment on an FHA loan, then you get like a 30 times, multiplier whenever there's equity gains. That's what happened with my starter home, and it was able to get me to upgrade into my next home and so on, right? That's the beauty. That's the beauty of this, of how you create wealth. So again, don't fear wealth, but do respect it. You respect that it can help or hurt you depending on the kind of steward you are and the kind of loans or debt that you're using for whatever that situation is. This is always a case by case decision. This is why in our coaching, we spend so much time working with people and say, hey, what is a good use of these loans? This is why when I don't mind using my life insurance loans because I know it's paying me just about as much interest as what it's charging me. It's almost like a zero net loan or a zero net debt, right? This is why Jim Harbaugh loved getting paid an extra bonus from the University of Michigan to be able to get paid millions in debt, which was a 0% interest debt, by the way, that he didn't have to pay back. He just had to make sure that if he died early, his death benefit paid them off, which, by the way, that's why a big reason to have death benefit to be able to pay off your loans so that you're not worried about paying them off early, like a mortgage that's super duper low interest rate right now. And he also had enough in there in cash that he could pay them off if he ever decides to pull out the money from the plan. Everything else he gets to keep. He gets to leverage all their money for free, right? For no interest. I mean, so there's, again, interest bearing or not, there's always those considerations. This is why it's always custom to you. How do you use it? What's the strategy and what's the tool you're using? And especially, who are you as a steward? That's what makes all the difference. So before you start to poo-poo all over debt, say the debt is evil, it's the worst thing ever, avoid it like the plague. Before you just jump into that little camp of like debt's evil and you should avoid it like the plague and everything else and sounding very ignorant, instead focus on what would a wise steward do in this situation? Would they use the loan? Would they use the debt or not? That is the real question you should be asking yourself. Come from an abundance perspective, an abundance mindset, not a scarcity, fear-driven mindset, and you'll come up with a much better, wiser answer that could actually make you millions of dollars more than the average Joe who's living their life in fear and wonders why they're always trapped financially. This is why savers get trapped, and this is why spenders get trapped as well. You need to become a wise steward of your money. To learn how to do so, remember, you can always visit us at moneyripples.com. Make it a wonderful day.